Hi there. In the previous video, we talked about how to make a journal entry of consolidation with a goodwill and how the goodwill comes when the parent company is paying more than the fair market value of the subsidiary assets and liabilities. But in this example, we will talk about gain on acquisition. And here we have the subsidiary accounts, inventory, land, building, customer relationship, and accounts payable, all of them at the fair value. However, the parent company pays cash of $4,365,250, and the parent company also paid some legal service. We learned from the previous example that when we make the acquisition journal, we take the fair value and ignore the book value of the assets and the liabilities. So here is the journal entry where we debit inventory by the book value, then land by the fair value, building fair value, customer relation fair value, accounts payable fair value. But the company here did not issue any shares. So we forget about all the common stock, retained earnings, and other accounts of the subsidiary, and we take the net assets. What do we mean by net assets? Which is assets minus liabilities only. The parent company paid cash of $4,365,250. So the difference between the assets and liability and cash payment is gain on bargain purchase or gain on acquisition. So please remember the difference between the exercise that we have seen it in the previous video, where the goodwill here shows in the debit account, and in this exercise where the gain shows on the credit account. How do we know this? In the assignment, you will see that based on your journal entry, you will be able to discover either goodwill or gain. For the professional service expense, it's similar to the previous example where you debit professional service expense and credit cash. Now let us talk about another issue, which is how to calculate the goodwill. Here we have the subsidiary company with book value, and then the parent company paid $877 cash for all the outstanding common stock of the subsidiary. It means the parent is going to acquire 100% of ownership. However, the accounts receivable fair market value was $142. The R&D were estimated to be $256, which is not here recorded. And then we need to calculate the goodwill. In this exercise, you need to differentiate between the goodwill of the parent company and the goodwill of the subsidiary company. When the parent is acquiring the subsidiary itself has a goodwill. What shall we do with it? In this exercise, you need to ignore the goodwill of the subsidiary. Why? Because as I said, the parent company will get the net assets, which is assets minus liability, but we ignore the goodwill of the subsidiary. So how do we calculate the goodwill of the parent company? Here is the answer. We get the cash payment by the parent minus the cash receipt from the subsidiary minus the accounts receivable at the fair value, which is 142 instead of 184. Then capitalized software costs, since we didn't mention about fair value, we will take the book value here. Then we take the R&D, which is mentioned here, 256, minus the liabilities of 200, and then we get the net fair value of 705. Subtracted from the cash payment, we get the goodwill of 172,000. So the key point that you need to learn from this exercise is if the subsidiary has a goodwill, drop it off. The last exercise in this video is showing the parent company and the subsidiary company. And the subsidiary company has fair value for some of the accounts. And now we need to calculate the goodwill as we did in the previous example. So here we start by the cash payment as we did in the previous example, 441, minus the subsidiary book value, 322. We get the fair value of the book, the fair value in excess of the par value, minus all the assets and the liabilities, we get the goodwill 21. So what is the difference between this exercise and the previous one? Is just getting the goodwill, which is 119. And in the previous example, I put all the goodwill in one account, which is 172. But here we split the goodwill among the assets here to get all the differences between them. So if you check the difference between the fair value and the book value of the inventory, you will find it 24. The difference between fair value and book value of the patent, you will find it 32. And then the difference between the land, fair value and book value, 22. And the long-term liability, you will see it's 20. And of course, the building has no difference. So the goodwill of 119 doesn't go into one account, but it goes to all the accounts that has difference between the fair value and the book value, and the balance will go to the goodwill. I hope you find this short video useful to show you how to calculate the goodwill, either in one amount that goes to goodwill or distributed among the other accounts. Thank you. Bye-bye.